I'm Charlotte McLeod with investingnews.com, and here today with me is Gareth Soloway, Chief Market Strategist at verifiedinvesting.com. Thank you so much for being here. Always great to have you.
Oh, it's always great to be here, Charlotte. Thank you for having me.
It is. And I was just telling you, I realized we haven't spoken since December. So much has changed. We've got a lot to go over. And of course, where I was thinking we could begin is with gold. So we saw at the beginning of the year, the gold price hit all-time highs. Right now, we're in a pullback since the Iran war began. And I wonder if you could start by talking about where you see support and resistance levels for gold at the moment.
Yeah. So the chart's interesting. And before we get to the chart, one of the things I want to just mention is that we've seen this change in gold ever since that rally that basically started at the beginning of the year, the final, what we would call a blow off top. People started to jump into gold, not because it was a defensive play, but more because it was a momentum play. And anytime you have an asset that is more of a safe haven asset, where it starts to become a momentum play, it tells you that the structure or the reason it goes up or down is now changing. And ultimately, it has to flush down enough until it washes out those weak hands that bought it for the wrong reason. For example, a lot of your listeners bought gold like I did years ago because it's a safe haven. It's a way to protect ourselves against fiat currencies and lots of other shocks. So if we look at the chart, we can see here that we had the big blow off top right here, right? Parabolic move from about the 4,300 level all the way to 5,600. We then got the sharp correction and this sideways inside bar, another correction, and now again a bounce, and we're starting to come in again. And really what we're seeing now is high, lower, low, lower, low, right? So essentially we've changed from an uptrend in the near term to a downtrend. And that really has me more skeptical in the near term that gold's going to turn back up and make new all-time highs. Instead, the chart's telling me that we're likely coming down to this 4,300 level, maybe a small bounce, then we'll break down to 3,900 here. Now, again, will that be the bottom in gold or not? That's a good question. I do think that there's potential for a washout later this year back to about the 3,500 level. And at that point, that's where at least I've already isolated down where I am going to be buying long-term positions, right? So again, I remain a long-term gold bull, meaning that if you look at the government spending and what's going on in the world and the fiat currencies and the dollar slowly being devalued and probably slowly de-dollarization as well, it makes sense to buy gold. For me, though, I want to make sure I get it as close to the lows on this pullback as possible. And for me, that's 3,500.
All right. So we'll wait and see, I guess, if that 3,500 level pans out. I wonder, so people, I think, are wondering right now about, we've kind of accepted we're in this sideways moving pattern. Maybe we can go down. I think people are wondering, all right, well, what then breaks gold out of this pattern we're in? For you, is it that we eventually flush out those people who were buying on momentum and we get back to the people who are in it for the reasons you were discussing? Or is there something else at play that you'd be watching?
So I think, and this is the interesting thing, is a lot of the same reasons a lot of people like myself were buying gold years ago and even more recently, those reasons are still intact, right? Again, you look at all the issues that are going on with government spending, and we're talking globally here, the debt loads that are being put on so many countries, so many citizens. So I think the underlying factors are there. It's more that first thing you mentioned, which is that you have this period where investors, generally the investors that buy momentum, they don't have the staying power to stick around in a trade when it gets boring or if it slowly drifts lower. And when they start to unload, it then pushes that sell pressure even more. Now, granted, we could still say you have sovereign nations still buying, Federal Reserve banks are still buying gold. That's absolutely true, but there's still a lot of weak hands that are in gold that could cause it to kind of correct back down. And I would even say that we have to remember that when things get bad, meaning like COVID, remember 2020 of March, even though COVID was the obvious reason why gold should spike, when fear absolutely hit and the panic was in the markets, even gold sold off. And so you might see some sort of event where the stock market really gets scared, and that could be the final drive from 3,900 down to 3,500. And then that's where you start to see the reversion trade and it start to trade back up.
I wonder if you can situate us a little bit more in terms of where we are in the cycle for gold. I've been hearing from many people that this bull market isn't over, and it's common to see these types of pullbacks even when you're in the midst of a bull market. So where would you situate us? I think people have a lot of questions given the dynamics we're seeing right now.
Yeah. And it's a great question, right? Because if you historically look at the last bull markets that went from, if we go back to the 1970s here, this bull market, if we look at how long it lasted, from the beginning point to kind of the top out, it was only about 1,200 days, right? So again, you're talking, that was about 3 years of a bull move. And then if we go to the next one, which was the beginning of the run going back to 99, that kind of, you could argue, really lasted until, I guess you could make a case that it lasted until 2011. That was a longer bull market that lasted about 4,300 days. So I would argue this, and this is a very interesting aspect, that we're seeing as essentially the U.S. financial state deteriorates more and more, the bull markets in gold are elongating, right? So if we look at that one in the 70s, late 70s, early 80s, it was shortest. Generally, the U.S. had their fiscal ship in order, right? But when you look at the 2011 top, that was just after COVID, when the Fed was really printing the most. We got the biggest parabolic move. And then obviously what we've seen more recently is arguably, you could make a case that the bull market started maybe at the lows in 2018. I would argue more in 2022, but this one could last, honestly, all the way into 2030 or beyond. And I think that, again, goes to that elongated cycle in these bull markets of gold. And listen, if somehow miraculously the U.S. gets their fiscal house in order and the world starts figuring it out, okay, maybe gold isn't the place to be for the longer term, but let's be fair. What are the odds that that's actually going to happen? I think, again, that longer term cycle is probably intact.
I like that elongation idea, because I think even when we were seeing those really high prices at the beginning of the year, everybody was sort of feeling, wow, it doesn't really seem like this is over, even though these are, the top levels of some of the prices people were calling for. I wonder, I wonder if we can also take a look over at silver and support and resistance there as well. It's had kind of a similar trajectory to gold. And I wonder if you see it following what is coming for gold as well.
Yeah, and I do to a large extent. I think, again, we just have to be a little bit more careful with silver, as it's obviously somewhat more industrial, and so it has more of a sway based on how the economy is doing. But what we can see is the same thing happen, that incredible move to $120 per ounce on silver, the massive collapse down to 64, a bounce, then another lower low, another lower high. And you can see, again, high, lower, lower, high, lower, high, low, lower, low. So it implies that silver is likely going to come down, small bounce, and go even lower. And I'm still looking for sub $50 silver. And I know people don't want to hear that, but you can kind of make a case for it, right? I mean, here we are in an economy that this oil trade might start slowing the U.S. economy and the global economy. And then also, if silver and gold and the metals are going to see a decline from kind of flushing out the weak hands, that combination could easily push us below that $50 per ounce level. And I think that's kind of where I'm eyeing here. On a technical basis, really this zone here, which was that final, notice how we kind of did this little bit of a cup and handle pattern and then broke out. And this would be a resumption or a retrace into that same sort of zone, which should act as technical support around $50. And I know it's amazing because, just earlier this year, we were at 120 on silver, but this is historically, silver is very, very volatile like this.
Well, I think for silver, you're right. I don't think people want to hear that we're going below 50, but maybe it matters how much below 50, because I've heard a lot of people say, well, it can get back to about that level. How much lower underneath 50 do you think it could potentially go?
Yeah, and that's always the tricky thing, right? Because to call a spade, when we got above $100 an ounce in silver, that was kind of where I was like, okay, this is getting a little ridiculous. It should pull back, and it still went to 120, right? So I mean, what we know is human nature is to greed or FOMO in at the highs, and then at the lows, that massive panic. So I do think, there's always a chance it goes lower. You could be talking $40 or something in that range, but we have to keep in mind that there is still a deficit in many situations with silver. You still have to mine it, which costs money. And so as costs go up, at a certain point, it doesn't make sense as much. And granted, silver's a lot of that offshoot of gold mining, but for the most part, I would say that sub $50 to $40, that would be the overshoot, would be down to 40. If you think about it, from 100 to 120 was a 20% overshoot. From 50 to 40 would be a 20% undershoot of that level. Either way, for me as a technician, looking at the long-term fundamental aspect, it's kind of like, okay, once we get down below 50, that's where I just start to slowly accumulate those longer term positions with my main thesis of where things are going being intact.
Yes, really important to keep the broader context in focus as well. Going a little bit beyond the metals, I want to take a look at the Fed because, of course, this week we have the latest meeting. I know that it's very widely expected for rates to stay unchanged this time around, but there's so much else going on in terms of Fed activities. We have the Powell-Warsh transition playing out. So I wonder, what will you be watching most closely, perhaps in the commentary after the meeting?
Yeah, I think the thing that everyone is going to be watching like a hawk pun intended in that situation, but I think the key is, does Jerome Powell tell us, is he going to stay on at the Fed as a governor, or is he going to fully step off? And there's been this lot of back and forth. And the reason why this is important, right? Because you could say, well, if Kevin Warsh is the Fed chair, then what does it matter who the governors are? But remember, it's about a vote. So nothing happens in the Fed without a certain number of governors agreeing that they have to either cut rates, stay pat, or lower rates. And so if you get Powell to stay on, it means that the weighting will be more towards a hawkish Fed versus likely Kevin Warsh is going to be more of a dove, as obviously the President Trump made it super clear he didn't want to put anyone on the Fed chair's position unless they were dovish and willing to cut rates. So I think for me, that's the number one thing. Is he staying on, or is he going to step totally aside? It'll really tell us a lot about the independence of the Fed as well, which could then let us understand what the long-term implications are if you obviously have the president having more power at the Fed.
Right. So it sounds like from that perspective, it could very well be an important meeting. You talked a little bit about what we can expect from Warsh. I wonder if there's anything else you would add, because of course there is that expectation that he will follow in line with what Trump would like to see, which is lower rates. But it seems like, in his commentary leading up to all of this, he's been saying he's not going to do that. So anything further you'd add?
Yeah, I mean, my concern is that to be confirmed, he has to talk the line, right? So even if he said something in private with the president, and we know how the president attacked Jerome Powell so much for not lowering rates with social media posts and all this other stuff, even an investigation, it does make me concerned that, Kevin Warsh is saying what he has to say to, make sure that he gets the position and gets voted by Congress to confirmed as the Fed chair. But the other thing that concerns me too is when he was testifying in front of Congress for his confirmation hearing, he said about changing the way inflation is monitored or how the numbers come out. In other words, what he was saying is that what the Fed needs to do is throw out any outlier numbers. So let's say oil jumps 30% in a month or 40%. His policy he would want to institute would be to say, okay, we're not going to include that in inflation. We're going to focus on everything that's kind of stable. And that's concerning because as a citizen of the world and of the US, that's not your real true read of inflation. And we know that. And so I think it's a little disingenuous, a little bit of a concern that that's coming up as kind of fudging the numbers a little bit. We'll see how it plays out. But again, I am a little concerned until we really see him for a few months as the Fed chair.
That is definitely concerning, especially when there's already questions about how some of these numbers are arrived at. And it's going in a direction I wanted to pursue as well, which is inflation. Since the Iran war began, I think concerns about inflation have really ramped up. And from what I'm hearing so far, it really depends on how long this conflict lasts, what the impact for inflation will be. But anything that you can share on what you see coming for inflation at this point?
Yeah, and I think the biggest thing on inflation is to understand that Inflation, if it was a 1 or 2 week or even a month shock of oil going to $100 a barrel, it will have a minimal impact, right? Because producers can kind of wait that out with inventory and things like that. But now we're going into, month 2, month 3 of oil being $90 plus. There's absolutely going to be a factor of inflation. And remember how inflation works, right? So prices go up for the wholesale numbers, meaning the PPI, producer price index. And eventually those producers say, hey, we can't eat this cost because our profits are getting, screwed. And so we have to pass it along. And so there's this kind of chain reaction that's like a 6 to 9 month chain reaction from whenever oil prices finally come down to where we see the end of inflation. And so, for a lot of people out there, they might be saying, yeah, prices at the pump are a lot higher, but we're not really seeing it everywhere else yet. It's coming, assuming oil doesn't come down very, very quickly, and likely it's too late at this point already. So I think that's something that I would just make everyone aware of, is that it's not like an instantaneous oil falls to $60 a barrel and there's no inflation left. It still will be passed through. And one thing that I hate about the system is that once producers raise prices, generally they're not lowering prices, right? We see this at the pump, right? Where oil goes up or gasoline goes up and it'll go up overnight, but then when oil or gas comes down, it takes months for that price to creep back down. And I do worry about that as well, the stress on the consumer.
Great points. I think all of those are super important to be aware of. And it does all tie back to oil here. And I wanted to ask, so we've seen a lot of oil price volatility since the Iran war began, as you've been talking about. Have you found ways to play the oil market right now, or has it been too much going on for you to be in there?
No, I definitely have. And the beauty of it is, you use what you have in your arsenal. And so the chart itself, here was this great topping tail on the chart of oil. And then we got this inside bearish pattern. Notice how it basically, the lows were right at the low of this line, this parallel lower band. And then the highs right here when we were back to about 115, that was the high end. And look at how oil fell. Now we're retracing to the underbelly where I expect oil to get back to about 105. But I actually still am in the camp of, I want to short oil above 100 here. And I know that sounds crazy because the strait is still closed. But I not only am looking at the chart, I'm also understanding that there's going to eventually be an off ramp here because the midterm elections are not that far away. And there is no way the president is going to have oil at $90 to $100 a barrel by November. And so at some point we are coming back in. Whether or not we go a little bit above 105 again, I guess we'll have to see. But I do think that oil by the midterms will be back at least at 70, if not even a little bit lower.
Interesting. Anything else you can say about what you are seeing in the charts about oil prices? I've started to hear some very, very high predictions for prices, but it sounds like you're going in that lower direction.
Yeah, and part of that is just understanding the president's psychology, right? So, as you trade the markets, anytime we get a big down day in the markets, you're guaranteeing like right after hours or the next morning, there's going to be some positive, social media post that tries to boost the markets. He's a president who does not like the stock market going down. He's a president who wants to be viewed positively based on the economy. And so, he doesn't want to keep oil prices up for very long. And the other thing to remember is when I was an early trader, all the top oil traders would always say the best cure for high oil prices is high oil prices. And what they meant by that is that when oil goes up, it kills demand, right? So all of a sudden people are paying a lot more at the gas pump. All these other prices are going up and they start pulling back on spending, which slows the economy, which then reduces the demand for oil. And so, these $200, $250 targets on oil, I don't see them happening unless, we really did get into a World War III type situation, especially with the midterms coming up. I think it's, again, more likely we're headed lower.
I think that midterm point, that's a good one to keep in mind right now. And talking a little bit more about Trump's psychology, you mentioned he doesn't like it when the stock market goes down. And definitely right now, we're not seeing that happen. I'm seeing a lot of questions from investors who are wondering, well, we do have all of this uncertainty. We're in a war right now. Why are these major indexes hitting all-time highs? So how do you see that?
Yeah, and it's absolutely amazing, right? Because we did see about a 9% drop on the S&P 500. And then within 3 weeks, we were at all-time highs. Just one of the most incredible rip-your-face-off rallies out there. And what I tell people is that literally the whole rest of the world could be falling apart. As long as the US economy appears stable and earnings are coming in strong, then the stock market will go higher. And so it's almost like, if everything around your house is burning, as long as your house is okay and your house isn't on fire, you're good. And that's the way investors are viewing it right now. That again, we haven't seen a major slowdown in the US economy. The labor market is kind of stagnant, but it's not like falling apart. And earnings generally, because of AI, they're coming in pretty strong as well. And that's the kicker. But the second you see any sign of a weak economic activity or earnings misses, the stock market has a ton of downside to it. The potential is for a massive, massive decline when the US economy finally stutters.
Do you have any thoughts on when you think that could happen? People have a lot of questions about that as well. And we're starting to hear, different terms thrown around. Is this going to be a recession? Are we going to go into stagflation? What's your view? And do you have any thoughts on the timing there?
Yeah, I would expect it sooner than later. And just to go to the charts here on the S&P, I always just rely on data as the best indicator. And what we see here is that you have this parallel that literally has marked the lows of the S&P going back to the COVID low, and that line just goes right through those lows. And then the high, you can see here at the bull market high of 2021, we tagged this trend line in 2025, which led to our rollover. And then just literally yesterday, we tagged it again. And so this tells me, at least as long as we are holding within this, the upside is kind of capped here and there's more likely downside. Now, granted, we could break out. There's always a chance of that, but we can't assume that until it actually happens. And then on the NASDAQ, this one's the one that's even more intriguing to me, is the NASDAQ has now finally tagged that upper parallel as well. This parallel goes back to the bull market of 2021 and the bear market low of 2022, tariff low and the 2025 high. But same thing, huge move, but look at us starting to already pull back today in the market. And last thing I'll show you guys is this is an interesting chart. It's the NASDAQ divided by the money supply, so the M2 money supply. And so what we're going to do is we're going to basically take this NASDAQ ticker, and we're going to divide it by M2, the M2 money supply right here. And what we get here is kind of a scary indicator. What we're seeing here is this is your .com high of the stock market value in terms of the money supply. And we're literally right there again, telling us that potentially we're in a bubble here, an AI bubble, just like we were in the .com era. And I think this is a really scary chart. If you remember, if you traded through the 99, 2000 bubble and then the collapse, the NASDAQ dropped about 78%. I don't want to go out on a limb and predict that because that's a crazy move, but I do want investors to kind of be wary here that valuations are stretched, no doubt about it.
That is definitely an alarming chart, but thank you for sharing. I want to throw in one question about Bitcoin. So I know we've talked in the past about how it tends to follow the stock market. And I know we just talked about how stock market is at all-time highs. Bitcoin, I know, is down substantially from its all-time highs. Are there still parallels in there that are less easy to identify, or are they diverging? What do you see there?
Yeah, and that's a good question, right? Because we did see Bitcoin top out in October, and then we had a top in the markets in October, and then that rollover. Then the stock market zoomed to all-time highs, and Bitcoin has bounced here, but it's still showing relative strength. And so, a lot of people would say there's a divergence here. I would almost wonder if the rally in the stock market is not a true rally and kind of what we call a blow off top, that final burst of energy. And maybe Bitcoin, which is the better risk indicator here, and the fact that it's bounced so shallowly and starting to turn back down, that could be a pre-signal of a rollover coming in the stock market of significance. So again, I would say still pay attention because it has been, through its history, a very good leading indicator for the stock market.
That's exactly what I was wondering. Maybe there's something in there that I'm just not seeing. So thank you for sharing. We'll start wrapping it up. I wanted to ask before I let you go, final thoughts, but also any other areas of opportunity that you're seeing right now that investors might be overlooking given everything that's going on in the world right now?
That's a great question. And I think, one of the things, there's so much push to be fully invested and leveraged in the market. And I think, people will say, well, the dollar's declining in value. And I think it's important to put that in perspective. So the stock market could drop 10% like we saw just a few weeks ago before this latest rally. And maybe the dollar declines 0.5%, right? And so, people have to make the judgment of saying in the short term, if the stock market, let's say, is going to correct 20% and you have your money in cash, and let's say gold is still going to go down to, let's say, 3,900 or 3,500, it's better to be in cash or in bonds and just make a small amount of money or even lose a 1% of that while everything else falls 10 or 20 or 30%. And then you have a lot of dry powder to then put to work. And that's kind of where I am at this point. I'm either short the market or I'm just waiting patiently in cash or in treasuries, waiting for that next opportunity. And I do believe it will come faster than we all think, whether it happens by year end or early 2027. But we can see the writing on the wall through some of these charts I've shown you. And I'd rather play it safe than be sorry.
Well, perfect place to end. Thank you so much for coming on to talk about what's going on in the markets. I always really appreciate it.
Thank you, Charlotte. Have a wonderful day.
You as well. And once again, I'm Charlotte McLeod with investingnews.com. And this is Gareth Soloway with verifiedinvesting.com.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.